Hi, it's Nero here from Investment Rise, and today I want to talk about what I expect will happen to the property market whenever interest rates do eventually rise. Because right now it seems that almost everyone's favorite game in the media is to predict when interest rates will rise. I'm recording this at the end of October, and even today we saw an article predicting that interest rates are going to rise more quickly. Home loans soaring inflation data sparks fear of interest rate hike. The Reserve Bank has previously guaranteed Aussies the interest rate would be unchanged until 2024, but new data may change that. Rising petrol and house prices have contributed to a broader jump in inflation, sparking fears the Reserve Bank will be forced to hike interest rates sooner than expected. It seems to me that the only ones sparking fears are the ones writing these kinds of articles. Let's actually have a look at what the Reserve Bank of Australia Governor had to say about the prospect of interest rate hikes. RBA's low challenges early rate hikes. Reserve Bank of Australia Governor Philip Lowe is challenging market expectations for interest rate increases before 2024 and has pushed back against suggestions that rate rises and tougher lending standards can be used to quell rocketing house prices. The article then goes on to say, although the central bank remains confident of a strong economic recovery in 2022 after vaccination targets are met and restrictions ease, the latest Delta lockdowns will cause an economic contraction of 2% and possibly significantly larger in the September quarter, and living with the virus will present a fresh layer of uncertainty for the recovery. This is quite different from our earlier experience when the number of cases was close to zero and there was a very quick bounce back, Dr. Lowe said, noting however that the RBA expected the economy to return to its pre-Delta track in the second half of next year. He said the delayed recovery meant wages growth would take longer to hit the 3% mark the central bank believed was needed to drive inflation sustainably within its 2% to 3% target band. Our judgment is it will take some time for wage increases to lift to a standard that is consistent with achieving the inflation target. This judgment stands in contrast to the expected path of the cash rate implied by market pricing. These expectations are difficult to reconcile with the picture I just outlined, and I find it difficult to understand why rate rises are being priced in next year or early 2023, Dr. Lowe said. He then goes on to address the issue of house prices. House prices. On house prices, the RBA governor said he wanted to make clear it was not on the bank's agenda to use interest rate increases to slow booming house prices, which are expected to grow by upwards of 20% this year. Therefore, as I've made it clear in earlier episodes, the RBA is not considering rising house prices in its decision-making criteria about when to raise interest rates. But the question is why? Because there's no doubt that our low interest rate environment is contributing to the rapid pace at which house prices are continuing to grow. Well, remember, the RBA's focus is on growing the economy and allowing many of the businesses that suffered during the various lockdowns we've had around the country to recover. Okay? That's their major focus. Now consider what would happen if interest rates rose by, say, 0.5%. In New South Wales, which is our highest price state, the average mortgage is now around about $750,000. So an increase in interest rates by about 0.5% would translate into approximately $200 per month increase in repayments. Now let's take a person earning around $90,000. Okay, for them to not feel that $200 increase in their monthly repayments, their income would have to rise from $90,000 to $93,500. Now that's a pay rise of 3.9%. But here's the thing, we haven't seen wages increase at that rate since back in 2011, so 10 years ago. So therefore, the only way that the average income earner could afford the $200 increase in repayments on that average mortgage that I mentioned earlier on would be to either dig into savings or to reduce their spending on various discretionary items, like maybe reducing the times they go out per month for dinner or whatever the case happens to be. But that's the one thing the RBA wants to avoid, right? They want to increase spending in the economy. They want the economy to grow. They want people putting their dollars back into the economy, not hoarding it or not putting it towards home loans. That's why the RBA is talking about wage growth as its key criteria in determining interest rate rises. And based on the current situation, the RBA governor has made it pretty clear that he doesn't think that our economy will get to a level where wage growth will be at a sustainable enough level for interest rates to rise until 2024. Okay? Unless, of course, something changes. But here's the thing. What if something changes? What if inflation blows through the roof and all of a sudden the RBA governor says, oops, sorry, I was wrong. We need to raise rates sooner than I initially had guaranteed Australia. Well, what do you think that's going to do to house prices? Okay. Now, of course, there are many out there who say, oh, look, moment interest rates rise, because of how high our house prices are, the market's going to crash and you're going to get a bargain. Okay. Now, that's opinion. Let's go back and look at some data first to work out, well, what's happened with interest rate rises over the last 30 years. And then let's look at some key lending criteria right now. Now, I think when you go through these two factors, it'll give you a good sense of what will happen to the property market whenever interest rates do rise. So let's have a look at the following chart. Now, this is a graph of the cash rate from 1990 to 2021, okay? And the source is the Reserve Bank of Australia. So now, over the last 30 years, if you can see, there've only been 4 periods where interest rates have risen. Okay, in 30 years, only four periods, okay? So let's have a look at them. So in 1994, interest rates rose by 2.75%. Then, between 1999 and 2000, they rose by 1.5%. Then, between 2002 and 2008, that's a 6-year period, interest rates rose 2.75%. And then we saw a 1.75% increase in rates between 2009 and 2010. So as you can see from this chart, the maximum that rates were increased was 2.75% before they were dropped almost immediately afterwards or shortly afterwards. Now, why is this important? Because essentially there are only 2 reasons why property prices can drop. Number 1, there are more houses, and we are focusing here on houses, so there are more houses available in the market than there are people looking to buy. Now, we know that's not the case, and I've outlined in previous episodes why I believe that the excess demand that we have over supply is only going to increase, especially from I think next year, and I think it's only going to put more upwards pressure on property prices. Okay, so in terms of the house market, there's no oversupply issues. All right. So then what's the second reason property prices could fall? Well, it essentially is because homeowners and especially mortgage holders can't afford their repayments and they have to fire sell. Okay? Now, how likely is that to happen? Well, consider this. Before October, anyone who got a home loan approved had to show that based on their current income right now, they could afford their home loan repayments if rates rose by 2.5%. But then since October, with some APRA intervention, that buffer has become 3%. So now going forwards, anyone who gets their home loan approved must show that they can afford the repayments on their current income, even if rates rose by 3%. Now, mind you, has that increase by APRA dented demand in any way, shape or form? No. I mean, there are still multiple bidders at auctions. Properties are selling in record time. There is still a significant shortage of land. All right, so the APRA intervention so far has made virtually zero impact to the market. However, let's have a look at why APRA has increased that buffer by 3%. Okay, remember the chart I showed you earlier on showed you that the maximum interest rates have ever been increased over any time period in the last 30 years was 2.75%. Yeah, we have a buffer of 3%. Okay, so what that shows is that if interest rates were to rise steeply, quickly, let's just say they did rise sooner than expected and they jumped by 2.5%, okay, it would mean that mortgage holders could still afford their repayments based on their current incomes. Okay, and remember the RBA governor has said that he's only planning on increasing rates once there has been some significant wage growth. Okay, so therefore whenever the rates do rise, people's average income should have increased by that time as well. All right, so therefore there really is no reason whatsoever that when rates rise, all of a sudden people can't afford their mortgages, because when they went for the loan application, they showed that based on their current income, they could afford that loan if rates rose by 2.5%, say before October. Now going forward, it's 3%. All right, now don't get me wrong. Yes, rising interest rates will have an impact on the property market, but it's not going to be catastrophic. Okay, here's what I think will happen. Whenever interest rates do rise, it will slow the rate of growth of property prices, especially in the housing market. Okay, it's not going to stop it immediately. House prices will continue to grow, driven primarily by the supply and demand dynamics and the fact that there is so much excess demand and we have these significant supply shortages. Okay, then at some point, if rates do rise high enough, the property market will just go flat for a while. That's it. There will be no major crash whatsoever, okay? Because of the way our lending environment has been set up in Australia. So in summary, don't be swayed by these media headlines talking about, interest rates rises. The RBA governor has made it pretty clear that rates are not going to rise until 2024, but even if they do rise sooner, as I've shown you, it's not going to be catastrophic for the market. Prices will still continue to rise if you buy in the areas where demand is higher than supply, okay? And so my takeaway message is this. Don't base your property investing decisions on the speculation from the media about when rates will rise. Rates aren't set to rise for quite some time now, yet the borrowing buffers that we have in place will ensure that the property market is protected. There is going to be no significant downturn, and if you focus on buying in areas where there is significant demand over supply, there's significant infrastructure investment, if you do your due diligence, buy in the right areas, it certainly looks like there is some significant capital growth to be had yet. Hey, thanks so much for watching. If you found this video valuable and you're thinking you might like my help to help you find an investment property, then head on over to nerocall.com to discover our unique 5-step process that's helped my private client group purchase now well over $66.2 million worth of property. And then if you like what you see, you can book in for a half-hour phone consult with me personally. Either way, thanks again for watching.